Very good evening, traders. Welcome to yet another edition of our Thursday classes, courtesy of Tamam Brokerage Services. Today we'll be diving into ICT and how we can approach the markets using the concepts present. So today we'll be looking at something that looks simple but very key, and that is how we can take advantage of the right market direction. That is a combination of bias and narrative. So market direction, that is a combination of bias and narrative. Then the entry criterion. So first and foremost, I would like us to look at what's happening this week. Realize that gold is having a very bullish structure, which mostly I believe you also anticipated or noticed it. While I was having a live stream this weekend about the weekly outlook, I expected this bull run the whole week. This whole bull run until this buy side liquidity up here. So we'll start by the concepts of how to understand the direction of the market and also the narrative behind that move. So it's a combination of not only one thing, it's a combination of time frames. You need to understand time frames. You need to understand that the particular time frames you should be looking at while building your direction. So time frames are very key. Then after time frames, then we can now go into the concepts. Okay, particularly we'll be talking about with ICT, we'll be looking at the PD arrays, then liquidity. Then after that, we can talk about the entry. Now, this and this PD array and liquidity, of course, match together with entry, but then, of course, here we shall also look at something like structure. But then, when you're using ICT, structure is very key, yes, but then we are more of, should I say, intraday trading, you will need more to do with PD arrays than a lot of structure. Structure is very important, yes, I don't undermine it, but then you will need more of PD arrays as key, especially if you're trading the 2022 model or maybe using intraday schematics to trade the charts. But if you're trading concepts, ICT concepts, but you're using criteria like Fibonacci retracement, and you highly need the structure. It's more important than literally the PD arrays, because you're retracing back to very key zones that help you pump price the upside. If I'm to check this, this is a fib tool, but then we didn't come back to the sweet spot here, but we're in a fair value gap zone, so still. So if you are a person using structure, you will look at more to do with the, so if you're using more to do with Fibonacci retracements, you'll use more of structure. Then you combine PD arrays like fair value gaps at those sweet spots for you to have a delivery away from those zones. But then if you're going to use the 2022 model, or maybe like you're going to be using things like the silver bullet, or maybe things like the stop hand models specifically, because those are just models inside concepts. Then you look at PDRAs. So we'll look at time frame alignments, we'll look at structure, we'll look at PDRA and liquidity, then we look at the entry. So number one, you need to understand the kind of time frames you're looking at. So what kind of trader are you first and foremost? So what kind of trader are you? So that one you answer it yourself. It's not subjective to a particular way of approaching the markets. Are you a swing trader? Are you an intraday trader? Or are you a scalper? Intraday trading is almost the same as day trading. The only difference is that you realize day trading you open and close on the same day, but then intraday it's more of session trading. You want to enter in a session and then maybe hold to another session or close within the same session. Then day trading you want to cover almost the bulk of the whole day. So literally intraday trading is the same as scalp trading. So now you need to understand your personality. Swing trading, with swing trading you're going to be looking at these particular time frames. If you're a swing trader, these are very key items you also have to look at, even if we are to go into other intricacies. So with swing trading, we are looking at these particular time frames. We are looking at the monthly chart, then we go to the 1 weekly chart, then we go to the 4 hour chart for our entries. That is a swing trader. Then an intraday trader or a day trader is going to look at intraday trader is going to look at the 1 day, then to the 1 hour, then to the 5 minute. Now this is a chronology of flow of the IPDA cycle, or chronology of flow of the algorithm to be more specific. Most times you realize that if you jump from swing traders higher time frame, then you use an intraday trader's entry in maybe a swing trader's middle time frame, you're going to get smoked. Reason being, they'll give you false structure, for example, false shifts, they'll give you false boss because you're using a different time frame. However, if you backtest your system also, you can find ways of how to identify them. Okay, so because someone can say I move from the daily straight to the 30 minutes or something, but if you backtest it very well, this is the chronology. Reason being, between the daily and the 1 hour, a bulk of price action is confirmed here. Between the 1 hour to the 5 minute, a bulk of price action is confirmed here. So it helps you to be more accurate with your system. So now someone can alternate 5 minute with a 15-minute chart. So you can stroke the 5 minute with a 15 minutes chart, but then I always try to keep my discipline when it comes to the models I use. So this is 5 or 15 minute, but then the 1 hour for intraday trading. Then for scalp trading, it's going to be the 4H stroke the 1H, then to the 15-minute chart, then to the 1 minute chart. Most times this is going to be for the scalp traders. So this is the first criteria you're looking at for market direction, or for you to deliver to a particular piece of price action and profit from the market movements using ICT or even other concepts. So swing traders will look at the monthly, weekly, 4 hour, then intraday traders look at the daily, the 1 hour, then the 5 minute. Then in case you want more clarity on structure, because you can, for example, have overlapping order blocks that can become breaker blocks on the 5-minute chart. We can also have, for example, they call them voids on the 5-minute chart, and then it turns out to be a fair value cap on the 15-minute chart. So if you combine the two time frames here, you can look at something good, and then you choose which PDRA you want to use here. Okay. you can find a rejection block on the 5 minute, and on the 3 minutes it's an order block. So all that, when you combine it, you can get something that you prefer to use. Then the scalpers, it is 4 hour or 1 hour to 15 minutes to 1 minute. So this is the first criteria. Now the monthly chart is for direction. That is the number one criteria. The monthly chart is completely for direction. You want to use the monthly chart to tell you where really price wants to go for the month. That is usually cuts across all these three. Okay, cuts across all these three. This is an overall direction, and this overall direction is attributed due to the fact that institutions or major market players, they will price their orders on higher time frames, not more of the lower time frames. So this is the overall direction and trend. So the monthly chart will give you the best for that. It will give you where the month is really going into. For example, if I check for you the gold chart here, you realize what? We are seeing a very bullish month. We are seeing bullish months. So this gives you very good clue for you to identify your trades. And it's better yet if this month is sitting on a strong zone. You just hold your buys. If you're swinging or even intraday trading, you trade to the direction of that trend. Now, it doesn't mean that every day you'll have to have a buy day, because we need to at least have those retracements on the daily chart for us to build more narrative on how to price. So the direction for the month is always on the direction for the trend is normally on the monthly chart, gives you the bulk of where price is moving. Then when you go to the 4 hour chart, you are looking for the market structure shift. Those are very key things to look into, the market structure shift. So the monthly, the daily, the 4 hour is for direction. Then the 4 hour, let's talk of the weekly, the 1 hour, then the 15 minute. We are breaking down now the second part of the time frame. It is for market structure shifts. So the monthly direction for swing traders, the 1 week for the market structure shift swing traders. Then direction for intraday traders, direction is daily. Then the market structure shift is the 1 hour. Then for scalpers, the direction is the 4 hour or the 1 hour, and then the 15 minute is for the market structure shift. Meaning, you need not to confuse these. All of them, give them a role and make it a trading system, because you want to make sure you want to be consistent with what you're doing. That's what makes you different from other traders. You just have a system. So the weekly, the 1 hour and the 15 minute consecutive on these different traders is their market structure shift. Then finally, the last time frame, which is the 4 hour for the swing traders, 15 minute or 5 minute for the intraday traders, and then the 1 minute or 3 minute for the scalpers. But to be specific, I would prefer you to use the 5 minute or the 1 minute, like this, if you're using the law of time frame alignment. So this is entry. So we have now our entries, all these. So this is time. Time is one of the most important things in ICT. And if you notice, ICT is it's literally 80% time. Then the PDRAs are where we call discount and premium. So that is for the sake of our time frame alignment. Then now, the next thing is definitely structure. Structure is very key, and usually the structure you look at it more especially on. Usually you can look at them on both time frames, usually all time frames. But then the structure for intraday trading is going to be the 1 hour structure. Then the structure for swing trading will be the 4 hour structure. Then the structure for scalp trading will be the 15-minute structure. This will help you give you the right direction for that particular trade. Because if you use a 5-minute structure while you're trying to make an analysis for an intraday, that is going to scam you. Okay? So 1 hour structure is, for example, this. So you can see the 1 hour structure for gold is very bullish. It is breaking It is creating boss after boss, boss after boss, boss after boss. It's breaking structures. There is a shift when I'm using so this is a shift. Then someone else would say I prefer this one up here, but then this one here, someone can say I prefer this has to be the shift. I start looking at my shift from down here because I use CISDs preferably. So price makes this can be a shift, then this one can also be a shift. So this is an early shift. Someone else says I prefer this one here. Then we start looking at things like sweep of liquidity down here for us to continue pushing to the upside. So this is order pairing. So price is pairing orders from this zone to continue pushing to the upside. What else do we have? We have a break of market structure. So someone who says this is a shift, then we shall put this a market structure shift. So now you ask yourself, based on the higher time frame, where is the market going? We said we prefer it to go to these highs up here. We prefer it to continue buying during the week. So if you've already made a decision that according to the daily chart, the direction is bullish, right? You say we are going to buy this price up here, meaning when you go to the 1 hour chart, you want to mark structures for you to continue pushing the price to the upside from here. So the shift first is here, but then for this, the shift is here. Then price consolidates here. On consolidating, what did we say? When price consolidates after a shift, we don't expect a reversal. It will be something we shall talk about next time. The IBDA cycle. The IBDA cycle moves from an expansion to a retracement to an expansion. But when it consolidates when it is consolidating after like a shift is complete, we don't expect it to reverse down. It will just manipulate and then push higher. That's what they call the AMD. So we'll have an accumulation cycle here. Then we have a manipulation cycle down to give us this sweep. Then we have a distribution. That will be the expansion away from this manipulation leg. So that's what happened here. After the shift is complete, there is no reason as why price should come back down here. You also feel it. After accepting that price is now confirming a shift to the upside, there is no reason as why I should come back down here. So what does price do? Price decides to, the IBDA cycle consolidates price around here immediately after the shift. In the process of consolidating here, what is it doing? It is engineering buy side liquidity and sell side liquidity. So to continue pushing this price, pumping it higher towards the buy side up here, what is it going to do? It's going to purge orders. We want price to come to these all-time highs up here. After the shift is complete, price won't reverse or price consolidates. So for us to continue going higher, price will remove orders. So it will do a manipulation down here. So the manipulation will sweep the liquidity of the consolidation cycle. Now what is it doing here? It is creating a false breakout for those who are willing to go short. Then after sweeping these orders, it will push back to the upside and then give you an intraday shift here for your entries. So those who can see this, we have a sweep of that low, of those lows, then we get a market structure shift here, a market structure shift here, and then price retraces back to a fair value gap zone. And then we pump contracts there. So after manipulation is complete, your only role as a trader is to confirm an acceptance that price has taken orders. Yes, thank you for taking them, but are you willing to go to the upside? How do I confirm that? I can't enter from here. I want to see a shift. When a shift is complete, then I can retrace back to a zone. And if you prefer to use a smaller time frame, you'll go to like a 5-minute per second shift. Then you pump price to the upside, targeting buy side liquidity. So you hold your trade from Tuesday up to when we hit it on Thursday. So that is how you will be trading using the structure. So one, you're finished to understand your time frame. I'm going to be a swing trader, so that means I'll use this. But then since me I'm an intraday trader, I'll focus on intraday trading. So with intraday trading, once again, for intraday trading, it is the daily. So this is the distribution phase, just like what you're seeing here. Accumulation, manipulation, then shift inside or a CASD, then price enters, we pump to the upside in the kill zone, push to the upside. And if it triggers outside the kill zone, you wait for a re-entry somewhere else, then you enter. But after the shift is complete, just sync with that. Okay, so that is that I was trying to make it a lot more clear. So from understanding the kind of trader you are, then you need to understand the what you need for each time frame. So the daily chart will give you the direction, and then the 1 hour chart will give you the structure. So the structure is supposed to guide you that we are accepting that direction that you've said on the daily chart. So price should now continue creating boss, not shifts. So after price makes a daily acceptance to the upside, gives you a shift, we need to start now breaking structure. So we need to start now making only boss. So if I can delete this, I delete this. So after price making a market structure shift, we are focusing on significant break of market structures. So this is a significant boss. Someone may say, why didn't you use this one? Yes, I can say I can use this, but then you realize that price consolidated in this cycle. So this whole thing is seen as one piece of price action. And on a higher time frame, it's an order block. So this is the most significant boss because it created a new low here that was broken up here. So if you're to get your tool very well, from up here, down here to finally that's when we broke it with a body here. So I wouldn't want to use this. So that is a boss. This was the most significant boss here. Then price created another boss. Someone can say this. Now this is the candle that broke this, that closed above this high. So this week here is just a manipulation week. It is for a false sell. People scalping lower time frames will use this to sell because I've seen highs here. So they fake you, then they come and take you out because the structure is bullish. Then another boss is somewhere up here, though it is at a very risky zone. I wouldn't advise for it because it's at a swing point. When price is at a swing point like this, you want to avoid continuing with that trend unless you're having other things into consideration. When reach swing points like this, you cannot control what price will do. What will happen is price can decide to sell or can decide to continue higher. So these are areas of profit taking. You should be focusing on taking profits from highs and lows. Or the number one and most powerful way to trade when you reach highs and lows is to wait for confirmation of two things. Are we having a break of market structure? Are we having a sweep of liquidity? So we cannot tell which one is going to happen. Rather, we use them as targets. So when price reaches swing points here, you will want to have taken your profits already. So you can wait for what price wants to tell you. Will price do something like this, then break structure to continue higher? When it reaches these swing points, okay? Or will price decide to reverse off those swing points? Will price decide to take those highs and then come back lower to give us a market structure shift of those swing points? So you're trying to avoid uncertainties in the market and focus on quality over quantity. So what can happen here is when price reaches such zones, price can decide to say, I want to take a sell program. Then it gives you a shift here and then sells down. See that? So when price reaches up here, you want to avoid that kind of noise. So this can be like a market structure shift. a retracement into an order block, and then someone sells off from somewhere there. Someone sells off from somewhere here. If you're using purely structure, look at this. Someone sells off from somewhere here with the 1 hour chart. So this is a shift, and then price decides to sell off. So you want to avoid that kind of noise. You want to focus on quality. Let price show you what it wants to do. Then you want to sell it down. So you don't want to fall trap for this. Someone can decide to do this. However, it can also decide to buy up continuously. So let price give you its true course. If it is to sell, it will give you a market structure shift. If it is to buy, it will continue creating a boss or a break of market structure consistently up. So you continue trading up like that. I prefer to use current data, like the most recent data that the market is printing, than to anticipate and then get glued to the, with anticipation, when you anticipate a particular price movement, logically or psychologically, your brain stops to multitask. You're waiting for that particular thing to happen. So you end up forcing the setup. So use current data. So buy side liquidity is mitigated, boss after a shift. We can't have boss before shift to confirm that particular direction. So price has to give a shift, then boss. Okay, so that is going to be with you with structure. Now, let's talk about how we would now start considering the entries for these particular trades. So let's go back to the daily chart. You've understood that the daily chart is for direction for intraday traders, but then you can do multi-time frame analysis, of course, but then you focus on those time frames to make clarity and avoid time frame paralysis. Time frame paralysis is when you're having a lot of data that you're looking at and you even fail to get the right ones because there's a lot of data being given to you at that particular time. So when you choose the particular kind of data you want to be looking at, you focus on those only to give you more refined vibe. So this is my daily chart as a day trader. If I can delete this and we talk about how we would trade this direction, then we shall also look at another chart to give us more, because here particularly we want to see how we consider direction and entries a trade. So time frames have been covered. Now we go to structure was covered. I want to talk about the PD arrays. Now the PD arrays are something very crucial in ICT as well as time. Now the PD arrays are premium discount prices. So what happens is that IPDA or the interbank price delivery algorithm will move to areas of discount to buy things at a cheaper price, and will move to areas of premium to sell at an expensive price. So if we are talking about discount premium pricing, we don't need to use the dealing range right now, but let me just show you how someone using a dealing range will look at it. So okay, let me just use this. So from a swing point, okay, to another swing point is what is called a dealing range. Reason being, this area up here took out some liquidity, probably, but this is all-time gold. Gold is always very bullish. Then it retraces back to discount of a particular range to give you a cheaper price. So when price moves from up and down here, it moves to a discount price at that particular time when it is dropping. It drops to a fair value gap. So a fair value gap, first and foremost, is not a liquidity zone. To those who have read or those who have tried to see Michael Harboston's teachings and his live streams, fair value gaps are areas of inducement, the areas of faking people into it. That's why you ask yourself, why does price retrace back to a fair value gap to give an expansion? It is not to collect liquidity, it is to induce early, to induce traders to a sell position. After inducing them to a sell position, then it gives a shift or a CISD to buy. That's why you can trust fair value gaps, trust order blocks. So if this is a fair value gap zone and it's an inducement zone, that means we don't trade the move to the fair value gap if we're in a bullish market. We want price to come back to this zone, mitigate this zone, And then we say, okay, if it has mitigated the zone and respected the consequent encroachment, the consequent encroachment is simply the 50%. Don't need to complicate it. 50% or the CE, just make it CE. So when price comes there, all that price does is respect the middle of this zone. Okay, the middle of this zone, then push to the upside. Sometimes, of course, it will just come up here, what we call the first quadrant. It's not also relevant. Just focus on the 50% or the CE. When it touches the consequent encroach, sorry, the first quadrant up here, that is 25%, means that price is extremely bullish, doesn't want to come to the middle here. Or if you go into understanding refining fair value gaps, you can refine a fair value gap and get a sweet spot of the fair value gap. Because in a lower time frame, you realize that this gap here has areas that have already been balanced and those that haven't. But don't focus on that. So price comes from up here into this fair value gap. Now when price comes down into this fair value gap, the question you're asking yourself is, let me remove this. When price comes down here, the question you're asking yourself is, will price hold here or will price crash below? You get that? Now, we are not gods or market makers to tell that markets will crash here. But we use our edge or our backtested knowledge that price normally respects fair value gaps. To confirm this, we need a CI, SD, or a market structure shift in the 1 hour chart we spoke about. So after price mitigating a higher time frame zone, then the first criteria is established. Direction is met. So we hit a strong zone. Direction is we want to buy. To confirm the buy out of this fair value gap, what do we want to see? We want to see a market structure shift in the 1 hour chart. I always see the use of the market structure shift on a 5-minute chart, yet the person is an intraday trader. Most times it is very tricky because it gives you a false market structure shift. You would prefer to use a higher time frame market structure shift to control price rather than a 5-minute market structure shift. So price dips into this fair value gap zone. After dipping into this fair value gap zone, then we start adding certain other criteria like, for example, this day we dropped, price rejected. You wouldn't have gotten an entry. I'm very cognizant. The real entry came from up here, dropped down here. This was the close of the day. The next day, price decides to drop again. Now, I have a model that I use to trade this. It's a very powerful model, but next time. So when price comes and it is inside a strong zone, it mitigates it for the first time, drops again for the second time, and does not take this low. Expect the sweep of this low to be the reason for the push to the upside. Reason being, order pairing is complete. So we are now having two criteria in place that are guiding our directional move. One, we are having a sweep of liquidity. We're having a sweep of liquidity. Two, we are mitigating a fair value gap, consequent encroachment, or the 50%, or the sweet spot, whatever you choose to call it. After mitigating it, now this is the day when you start guiding yourself to push to the upside for trades. So now after price tapping the consequent encroachment and sweeping this previous day's low, we go to the 1 hour chart. Okay, when you go to the 1 hour chart, we now start asking ourselves, number one, on which at what time did the day start? At what time did the day start? So you realize that here we had news. I see this news here out of coming from this consolidation phase. So this is a consolidation phase. Now I can easily see this. We have a consolidation phase here. So what did price do? News came from up, swept down here, then bought. But let's first look at exactly how we opened that particular day when we took these lows. So I'm already familiar with my chart, so I don't have the session indicator, I can tell. So from here, the beginning of, with gold the pricing is different. So beginning of gold from there to midnight, and I'm using, okay, this one is UTC, so this, let me just use the Ugandan time. So from midnight Ugandan time, but then gold does not have midnight, so we'll begin from 2300 hours to midnight. sorry, to 7 in the morning. That is Asian session for you. I use UTC time. So for now, I'm presenting it using the Ugandan time. So price begins from midnight to 7. This is what? This is Asia. So during Asian session, we ask ourselves the questions of what? What time did price hit the strong zone? It hit it in Asia. Now, when it hit it in Asia, we don't expect price to come back again and hit it for the second time. So those who use, for example, sweep of liquidity of Asian session low, sweep of liquidity of Asian session high, as long as Asian session has engaged a strong zone, do not expect price to again come back and sweep Asian session low. For example, if we want to buy price, okay, we want to buy price to the upside, and then Asian session comes and then hits the daily zone and then decides to displace. Don't expect price to come back and take Asian session lows. I'm basing on this, not this. This is news. But if you're trading normal price action, when price engages a higher time frame zone in Asian session, the rest of the day expands up. So that's one of the easiest models you can use to understand bias. Use Asian session. What has Asian session done? If take an example, you've marked a zone like such, and then price does not engage it in Asia. That's basic price action, but very powerful. When price comes and does not engage it in Asia, and it is just up here, do not force the buys yet, even if a false market structure shift is confirmed here. Because we want to use higher time frames, then you go to lower time frames, then you go to the entry time frame. So this is Asia. When Asia is here and there's a strong zone up here, down here, wait for London session to give a manipulation or a stop hand. Then you get a CISD to enter and then buy price the upside. That is logic. But then if you come and then you find when price has already engaged the Asian session, so the Asian session has already engaged the strong zone, just expect London to expand away. So we'll get a re-entry, then we just push to the upside throughout till New York. That is very understandable, I believe. So price engages off from there, as simple as that. So what happens here is price engages a strong zone, we begin to push the upside. On this particular day, the price action wasn't directly easy, right? Because we had news. This was news on Thursday. Thursday, that was, this is Thursday, what? 10th of October. So price drops down, repairs orders to push to the upside. I have a system in place that I use for trading news. Whenever news takes liquidity, it delivers away from liquidity, despite structure. Despite structure. So despite structure is bullish, despite we're coming from a strong zone, as long as news mitigates, for example, Asian session highs here, we take Asian session highs prior to news. Expect news to deliver away from Asian session highs before it can resume the trend. That's why they say news can either manipulate or distribute. So if we take Asian session highs prior to news, news will first come back, pair orders, and then rebuy to the upside. Then it buys back to the upside. Then a re-entry is here. Now, according to my trading system, I don't go to the lower time frame more than the 1 hour. But if you're a person who prefers to use the 5-minute chart, you can enter off this rejection off here. But me, I prefer price to close above this order block. I retest the order block and then I begin to buy price the upside in the kill zone. So this is at 4 p.m. Ugandan time. In New York time, I know it as 10. So this is the entry for this particular trade on this day. So if you're trading news, normally you want to wait for sweep of liquidity, you trade to the opposite side. But since structure is bullish from a strong zone, sweeps this liquidity and then rejects the upside, closes above this, you enter. To a 5-minute entry trader, you will come and look at this rejection of the strong zone. When price drops and sweeps this liquidity right here, what are you looking for? You're waiting for a displacement back up to complete a market structure shift. So this is a market structure shift right here that you're seeing. So when news makes the false, it's a double agent user. double edging, this is where we have two-sided news, right? News drops to one side and to other side. So price pushes the upside. This is a market structure shift confirmed. When the market structure shift is confirmed, what are you looking for? A discount, fair value gap. Avoid fair value gaps up there. Look for discount, fair value gaps for you to take your trade. So price comes back down here and we find a fair value gap here for your entry. As simple as that. Then don't control the IBDA cycle. We can't control it. It decides to consolidate, right? And the same thing happens here. So you see that's why price is very fractal. The same way we saw on the daily chart that after a market structure shift, price can choose to first consolidate. It does the same thing here. So price decides to consolidate after the market structure shift off the strong zone and then delivers off later. So the whole of this is a consolidation cycle on this very strong zone. But then for you just enter your trade from there. You enter your longs from the fair value gap. Then you know you're going to prefer to know your stop loss thingy. But normally, since this is a rejection block, I can say, let me put it below the open here because price can come back and retest here to push to the upside. Then I get like 1 to 6R or 1 to, depending on what is given to me. And if my buy side is still to the upside, I can still target like this high up here and then hold the trade throughout for the 5-minute entry traders. But I am a person who is very realistic with my trading. I do not hold abnormal abnormal what? Abnormal take profits like this. I always focus on I see mine I take money. So that is 1 to 5R or 1 to 4R maximum. Then the rest let it go. I wait to capitalize the next day. So you see, price makes about 1 to around 6R, then begins to consolidate around here. Begins to consolidate before it again makes a second push expansion. So this is something like this. Then price takes these lows, a new shift here for maybe the next day's entry if you're having a continuation. A scalp trader using a 1-hour chart. Then another re-entry somewhere here. Then you can push price continuously until we mitigate the highest time frame liquidity, that is buy side up here. So that is how you will capitalize on time frame alignment. Very, very, very powerful. This entry also at 3, that is New York time. So price pushes the upside. Okay. So what have we looked into? We have said that number 1, understand direction. That is, use the daily chart to show you where we are going to. Then 2, you go into understanding the 1 hour needs to give you a market structure shift. Now, the market structure shift should not be one thing that should be misused. You can get an early market structure shift that can scam you, and that is why we always have the hardest time. I think it was one of the biggest things that disturbed me while I was beginning my trading career, identifying the right market structure shift. Reason being, in the process of price dropping to the downside, we can even literally have something like this. A false one. This high has been closed up, but then price comes back to a fair value gap here. Then I decide to enter from here because after all, we're in a kill zone. After all, price has shifted. Then I expect, then price does something like a sweep of this high or a retracement before it comes back down here. So you want to expect the market structure shift that have hit the strong zones to respect your direction. So price drops finally, then we can now begin a decent break of market structure, push to the upside. So avoid this market structure shift before you hit a strong zone, and this calls in for patience. So this can be a daily strong zone, a 1-day FVG, a 1-day FVG, and then this is our 1-hour market structure shift. You see how I'm very consistent with time frames here. 1-hour market structure shift. Then after that, then we want to come back down here and then mitigate fair value gap. Then you can decide to go to the 5-minute chart for a refined entry inside this strong zone. Then you hold your trade to your buy side or sell side liquidity respectively in a decent protocol. So price holds on targeting up here contemporaneously. Same thing like this. Okay. So I had this data on my PC, but then currently I'm not using my PC, so this is the company PC. But then the data is there. Bitcoin had very good example of also what we're talking about. You have to go to the daily chart. The same criteria. What is happening on the daily chart? We're looking for direction for the week. In fact, the weekly is very good, but I haven't spoken about it that much because people always get that time frame paralysis about it. The weekly is a very powerful key because the weekly shows you how the whole week will move. Then the daily shows you how the intraday will move. You get that? It helps in that way. So if, for example, the week before we had very strong rejection and sweep of liquidity and having a sort of bullish, you see this sweep of liquidity of previous week on this week, we're having a fair value gap present on this very same strong zone. We are having a very strong rejection candle close. You expect this week to pop to the upside. It is like automatic. If you really believe that if that delivers price or the algorithm delivers price, the algorithm will do the same thing again and again. So price takes this liquidity, closes above this fair value gap. This week we pop to the upside targeting more buy side liquidity. This can be your first target up here, or price continues here if the month gives you more. So when you go to the daily chart, we can clearly see price came from down here, closed above the fair value gap on this second day. Then now you ask yourself the question of, now let's mark this current week. This current week began on okay, the 7 days begin on Sunday. If I'm using the one I studied at school, yeah, for us, that's I remember they say the first day of the week is Sunday, but then it's always Monday and stuff. But then Monday is here, then Sunday is here. So with Bitcoin never stops trading. We have that continued move. So what do we see? Sweep of liquidity, close above fair value gap, a shift. Okay, a shift is here. Now someone will say this is the most prominent shift. Yes, this is a prominent shift. Okay, but then when price dropped this high here is also part of what you look at as a shift. This one here. Now for me, I can easily take this trade because I use CISDs. But an SMC move will decide to look at this and then you fail to get a retracement down. But CISDs are early shifts. So this is a daily chart. So a 1 hour shift will give you a decent structure here for you to use. A decent structure for you here to use. So price drops, sweeps this liquidity, pops the upside, closes above this fair value gap. It's enough to confirm that price is going to the upside. Breaking this fair value gap is a very good sign of going to the upside. Before when we get a shift, if you're using ICT, right? So fair value gap invalidated becomes an inversion fair value gap, inversion FVG. So when price pushes the upside and closes above the fair value gap, what do we look at? We look at now PD arrays. We look at the order blocks. This order block, this order block, this order block. But then the question is, which is the most valid order block of all these three? Someone will say this one. Someone will say this one. But then the answer to that is what we spoke about in the previous class. We want to see the candle which is displaced above to be the valid shift. If we have this order block here, and then this green candle that is reversing to close above it, closes above, let me say, decides not to close above, opens from here, and then stops here. It is an example of, this is type 2. So if I can give an example of price closing above here, this means this candle is not yet valid. It's not yet a valid order block or a valid use for a shift. Then finally price comes and closes above on this second day. So finally, we can now trust that this is now a valid shift. So this order block, or this particular order block, would now be respected. So according to this, and then you have situation where price does not come back to this order block. Price continues pushing higher. We can't control that also. We see that price will still want to push to the upside. So an example here. On the daily chart, this is the last black candle, but price pops above. Price fails to close above this immediately to retest. Price closes above this. So 1, 2. So that's why I say an order block is the last green or black candle, or the last buy or sell candle, or a series. A series means there can be one, or there can be more than one. So they close above, right? So now to confirm this order block, we need the displacement above which one of these three. They closed above this, it's a good order block, yes. But then price continued and closed above this one. See this, price closed above this one here. So this becomes the valid order block. This becomes the valid order block. So you won't expect price to come back to this one's open. Price will use this one's open instead to push price to the upside. You can backtest that for yourself and you realize it also. You can take a good look at this particular zone also. Don't get confused, this particular zone. What happens if we're using this to down here to up here? What happens? Price failed to close above this throughout these days, to use the week. Finally it closed above this, but it closed above this one also. So do you see price use this one's open instead of this particular order blocks open? It used this particular candle. So it is a series of up close or down close candles before a continuation in a trend. So price taps here and then pops as a continuation of this particular price action. Okay, so what happens is price taps this zone, this open here, and then drops. So there's also a mechanism for trading this drop here. Mitigate this zone. After mitigating the zone, you go to the 1 hour chart. What are you waiting for on the 1 hour chart? A market structure shift. As simple as that. So price drops, mitigates this zone. Then you ask yourself, what next? I want to see a market structure shift or a CISD happening in price for me to continue this particular price action. So we can look at this zone being mitigated on Sunday, beginning of it, and then price rallies away from this zone and closes above this. You can see this very well from here. This high created this low came back, consolidated, broke above that high. So this is the valid shift. A market structure shift must be a body close above a high. If it is just a week, just know that is a sweep and it can smoke you, like it can reverse and take you off. We need a full body candle closure above a high to confirm that price has accepted to go to that upside. If you consider shifts like this and then you start looking at zones, price can easily come. This is just one good time because we are from a strong zone. But if price uses a wick and fails to close with the body, don't trust that to be a shift. That is a false shift. So price comes back for the second time. This still stands. Then price closes above here. Or someone can say, I prefer to transfer my shift to this. Then I use this as an order block. Still, it can also work. But then I hold this. Then price comes and then does this. So I still have my inversion fair value gap here for re-entry. So price comes back here, or someone can say, I prefer to say this is where my shift is. So I'll use this order block. It's all up to you, depending on your back testing and your preferred trade. So price enters from here, and then we push to the upside. And then we push to the upside. You put your at these lows. That is for me who uses the 1 hour chart. Then for those who would prefer to use the 5-minute chart, you'll go to the 5-minute chart and do the same criteria. You'll go to the 5-minute chart and do the very same thing. From here, when price engages this strong zone, you're waiting for a new market structure shift, right? So price dips here. What do we have? A fair value gap here. A fair value gap is here. Another person can say, I prefer to use maybe an order block which is somewhere here. So price closes above, retest, then buy. So you put your entry at this fair value gap, or you can decide to, in fact, the entry will be here because we need to first close above this fair value gap high to confirm that this is an inversion. So price first uses a wick. You can see here, price comes, uses a wick, no entry yet, no entry yet, makes a false move, finally closes above with this candle, so retest the open, pump to the upside. That is when you're using precision to avoid a false move. Then you hold the trade to the upside, pump it to the upside until you hit the take profit. So that will be how you'll delve. So put in mind, understand the kind of trader you are. Is it time frames? Then use the 1 hour market structure shift to confirm that that higher time frame is valid. Then the 5 minute for your entries, and then you'll have a more consistent approach to the markets that is there with you. So I see you have 2 minutes. I don't know if you have any questions. That is with you guys. Okay. Anyway, I just wish you a good evening and a nice weekend and a trading week to come.